Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our EIA show, because remember, it's flipped because of Martin Luther King, the holiday on Monday. So we want to look at three key pieces, as we always do. So we're going to break it into the three parts. The first part's going to look at, will builds continue? And the short answer is yes, because obviously we're in that build period. But to what degree? Where are builds going to settle out? Is it going to put us into a bearish situation going into spring and summer where we have peak demand? Those are some of the key pieces that we really want to look at. And honestly, what product? When you look at it, even though we had builds in crude, we had builds in gasoline, distillate still had a draw. And it was a sizable draw for where we are right now, given where storage is. So these are things we really want to consider. Then when we look at total demand in the U.S., demand has still remained very weak. And we want to say, okay, well, is it going to bounce? Are we going to get this benefit of some movement and some activity as we get into February? And then we're going to look at the global market, because so far global demand for crude end products has been shrinking. And we want to see, okay, is this more of a one-off? Is this more of something that's going to be consistent? And those are some of the key pieces if we wanted to encapsulate what we're going to look at. So getting right into it, this is something that we talked about in the Econ show, and I'm going to show the same slide in segment 3, because it's really important. Because when you look at manufacturing, it consumes diesel. Like distillate goes into manufacturing, whether it's to get the raw materials, to move the raw materials, to refine them, to turn them into something else, and then to ship it to the port, and then to get it from the port to the end markets. You're always going to be consuming distillate, and more importantly, diesel. So as that shrinks, you're inherently going to see that demand come down. Now, the question is always going to be by how much. So one of the big components that we've been talking about is that when you look at 2008, demand came down 6 to 8%. And when you look at how things have changed since then, we could still see a drop in total crude demand, but black oil demand. When you look at OPEC includes liquids. So it's really important now to look at natural gas liquids, naphtha, or condensate, depending on, just to put it into its totality. There's a growing demand for petrochemicals, and it's, even though petrochemical margins are terrible, you're seeing utilization rates get cut in the U.S. You still have new facilities coming online in the Middle East, in Asia, and when you spend billions of dollars on a facility, I can assure you it's going to turn on. It may not go to 100% utilization rate, but they're going to try to cover their fixed cost and let the variable ride. So you're going to have a natural consumption of a lot of this capacity. Now, you also have a distillate shortage. So if you have a distillate shortage, well, propane is an easier way to replace diesel. So now you start looking at this and say, well, is propane going to get more demand? And are we going to see this growth? So even if you look at the OPEC number, and let's just use an easy number of 100 million barrels a day of demand, you could see 6% come out of based on distillate. So it goes from 100 to 94 million barrels a day. But you have new NGL capacity coming out, new demand coming on. So when you look at the whole number, it could look much better when you look at things going forward, which is why we've talked so much about natural gas liquids, and we've built a natural gas liquids model, because we want to look at NGLs. So we've built a model that you can ask us about. We'd love to hear from you on it, looking at the supply demand and then forecasting supply demand for NGLs, because it's such a big component of our future. Now, the other thing is global oil markets, again, are facing a bigger surplus this quarter than previously expected, according to the EIA. Demand is still constrained despite China's reopening, because you had wave one, you're going to have a second wave. You also have supplies coming out as Russia continues to defy output. Rystad came out and said that, the price cap isn't as successful as initially perceived. I'm pretty sure we've been saying that, but that's just me. I'm just throwing that out there. And then global oil demand is going to add about IEA is expecting 1.9 million barrels a day this year, hitting a record of 101.7. But as we've been saying, we believe a huge chunk of that is going to be driven by NGLs, which is why our NGL model, I think, is going to be so important. Now, when we look at the total products, remember this is a day lag, a week lag, but when you look at total oil and product stocks, you can see here that we flipped to surplus. We're now 15.9 million above the average of the last from 17 to 19 and 22 range, and but again, we should be here, and that's the biggest component of where are we going to go from this point. When you look at total crude land and floating, surplus narrowed from 31.7 to 27.1, but you can see we're still above the average. And then total oil product stockpiles, the deficit narrowed from 32.1 to 11.1, with a huge chunk of that being gasoline and light distillate, where we continue to have a massive glut. Now, just to quote Rystad, effects of the Western oil price cap and the EU import ban on Russian seaborne crude exports have not been as devastating as some industry players predicted. Seaborne exports of Russian crude on January 1st to January 15th are estimated to average around 3.1 million barrels a day, rebounding to October and November. And more importantly, the share of tankers that carry Russian oil and are dependent on Western services and insurance has dropped from 60% in summer of 22 to 30% after December 5th, and that will continue to get reduced over time. When we look at land storage, you can see that the deficit narrowed from 32.5 to 8.1. West of Suez, it actually flipped to surplus, went from negative 21.6 to 3.3 million. And then east of Suez, the deficit widened slightly from 10.9 to 11.4. But west of Suez is going to be important because we're seeing some steady builds in both the U.S. and in Europe, and that's something that we don't see changing. And the reason why we say that is because imports are increasing a bit, but more importantly, we're getting builds even with and really driven by the fact that refiners just are not as active as they have been in the past. So we have a big slowdown in refining capacity, which is the number one demand driver for obviously what's getting pulled out of storage. So if you don't have refining, well, you're going to put crude in storage. Now, the problem is, even with refiners not as active as they normally are, seasonally speaking, we still had a build in gasoline, and obviously we had a draw in distillate, but the draw wasn't as big as it could have been given how limited we are. And a lot of that is driven by weather, the slowdown in trucking, and just the economy in general. But we do see that starting to shift as we go into the end of January. Floating storage, the surplus now are from 31.4 to 24.1. The deficit widened in west of Suez from 2.8 to 3.4. And then east of Suez, the surplus now are from 26.7 to 21.1. And again, some of that has adjusted. We've actually had another increase. So when we show you this chart next week, you're going to have an increase in west of Suez, a continued drawdown in east of Suez. But Middle East, you had another build. And that's what we've been talking about the most, because the Middle East is going to be a problem. And that's something that Saudi's going to have to address, which is why we do believe there's going to be another OSP cut. And if they do what I think they should do, we should get a sizable cut in the OSP into the United States, because that is how you would clear a significant amount of what is sitting in storage, as the U.S. just increased their imports to 4-month highs from Nigeria, because we need medium sweet. We need medium, we need heavy, heavy sour, heavy sweet, whatever we can get, because we need stuff that is on the heavier side of the API gravity scale. So crude stocks had a build of 8.41 million. That's 2.5 million over the 5-year average. That's 34.2 million year over year. And then the SPR has now again essentially stopped seeing draws, and that's something that we think is going to be consistent, just because we don't need to draw anymore, and we should start to see some of that crude coming back. Now, they issued a tender. They rejected it just because the pricing wasn't there. But remember, the first few tranches of the SPR release was for rent, not sale. So we will start to see some of that come through with interest. It'll just be a matter of time on the terms that were given. Pad 1 had a small draw of 290,000 barrels, but we had sizable builds in Pad 2 of 5.68 million, Cushing of 3.65. A lot of that is just because, again, the differentials from Pad 2, from Canada down to Pad 2 is there. You're going to take in whatever you can because it makes sense. And you still have a fairly reduced number of refining activity, but imports also were really light. We should have seen a spike, and here we are. Pad 3 build of 1.38 million. That's 25.2 million over the 5-year, 28.4 million over the year-over-year. So again, a sizable number in Pad 3. And then Pad 5, another sizable number. So when you just put that into perspective, in Pad 3, this is the second highest we've ever started. The only time it was higher was, I know it's a shocker, 2021. So here we're in a position where we do see this increasing. And we don't say that just because we want to be bearish or we want to, it's just when you look at seasonality, you normally have a fairly steady seasonal build. It'll vary as to where that season, like the seasonal build has been, but 2022, 2016, you can see that there's that steady rise. And just given what's in the market, we don't see a rate of change that's going to be parabolic like we saw in 2017. It's just going to be something, a fairly steady number, and it'll likely go above where we were in 2021, but below where we were in 2017, especially in Pad 3, especially if I think Saudi does what it should do, or what I think they will do in terms of cutting some OSPs into the U.S. Cushing, you can see it's starting to increase, but typically, and depends on the year, you can see some years we have draws, some years we have builds. Given the differentials between Canada and the US, it's likely that we'll continue to get builds, and we expect some of the rate of change to level off a bit. The big piece is going to be, where's refining activity? Is that going to adjust? But again, we should see some of that as well. Runs, there was an increase of 1.2% utilization rate, but you can still see it's well below the average. And then when you look at the actual runs on crude oil of thousands of barrels per day, we're 1.38 million barrels below normal on just the run on the actual crude flows. So there's a lot of, there should be some increases. Pad 2 came back a bit. Pad 3 came back a bit. Pad 5 came down slightly. But we should see some of those increases closer to 90% as we progress through the end of January. But people and refiners might be looking at this and saying, well, gasoline cracks aren't all that great. Distillate cracks have weakened. What's the rush to come back? And that's where you could start to see some economic run cuts. Not so much in the U.S., we should come back, but it's more Asia-based, where you could see some of them saying, well, we were going to do planned downtime at the end of February, can we pull that forward? And you could start to see some of those adjustments, and that would reduce some of that demand, especially in Asia. When you look at just putting it in perspective over the last 10 years, you get an idea of where we are. And typically we start higher, and then you start to see those declines as we get into February, because that's when you start your downtime. And then you do all your maintenance, you do your work, end of February into March, and then you start to ramp back up in April as we prepare for spring, driving season, and the like, which is why you then get that steady increase back up. But you can get an idea of how low we're starting, but the comps get easier. So that's why, getting to 90% and then leveling off will put us, right back into what is normal. Imports, you can see there was an increase of 511,000 barrels a day. It's still below the average. You can see Pad 1 had a nice spike. Pad 2, as we said last week, it was a big number. We figured it would kind of level off, but it's still above the average. And that's where Pad 2 is going to stay above that 5-year average and either, go to the top end of that cloud that we're going to show you, or stay right above the 5-year. Pad 3, nice increase of 460,000 barrels, but they were too low last time. So nice to see that bounce. And then in pad 5, we should see a recovery after seeing another decline. Imports, you can see we're still at the low end. We're still below the 5-year average. We're going to stay there. But based on some of the dynamics in the market, we should stay and hug a little bit closer to the 5-year average than we have in last year and the year, really last year. So again, we should stay at the higher end, but of the bottom of that cloud. But again, just still below the 5-year average based on the flows. We're at pad 2, going to stay at the high end, if not at the high end, at least above the 5-year average, just based on the economics and the movements coming into the market. Implied demand, you can see here we had a bounce to 8.05 million barrels a day of gasoline. We were expecting to get a little bit closer to 8.2. Instead, we're still stuck around this 8 million barrels a day. There should be a steady grind. The problem is we have another big weather system coming through, and that could really impact how much people drive, because you see the rain, you see the snow, and it's like, you know what, I'm not gonna challenge that. So it's going to be something to watch, and that could impact things just because it's coming across the whole U.S. again, and that's typically when you see the biggest impacts. Distillate, small bounce of 203,000 barrels a day. That's a bounce. We do see that fading just because diesel demand has come down from trucking, and we still have some warm weather that will give way to cooler weather. But again, it's something where we still think we'll be just below 4 million barrels a day. Jet still within that confidence range that we've given you, as resid is pared back a bit. Propane, bit of a bounce to 1.5 million barrels a day. That's an increase of 297. It's still below the 5-year, and just given where weather is, we don't see that adjusting. Other oils, which is kind of a catch-all, and will typically get run back through the refiner or exported as something else, or components, had a big spike. But typically there's a lot of margin for error in that. So that's another reason why we don't talk about it as much. And we want to focus more on the mobility fuels and less about something that's a catch-all, because typically a 1.787 million barrel a day increase, you're going to get a big adjustment to the downside. Gasoline demand, you get an idea. As we've been saying, we normally get increases at this point in time, as you see where it is. The rate of change is actually right in line with 2021. So we do see that increasing, but it's going to level off. And as we've been saying, it's going to level off before we get to what is closer to normal. We're still below where we were from last year, and that's something that we do think continues. And instead of getting to, let's call it a steady state of 8.5, 8.6, we see a steady state of closer to 8.2, which is still going to be disappointing versus previous periods. And then you look at crude oil inventory across the U.S. This is the fourth highest we've been, but we expect builds to be fairly consistent as a rate of change. So we had a pretty sharp rate of change here. We see that leveling off just a bit, but we do see imports continuing into pad 2. When you factor in crude and flow and product storage, here you can see that we're tracking above 2022. And we think that's going to continue just because gasoline, we see more builds, as well as in the crude space as distillate continues to remain in a bullish backdrop. Days of supply, based on where crude storage is, where refinery run rates are, it's going to remain elevated. Gasoline storage, you could see that we typically have these increases. So we just think it tracks fairly, it's going to track higher. We think the rate of change is going to be fairly steep. So even though it's starting at a positive point, we do think it gets much closer to where we ended 2022. So we do see some sizable builds over the next few weeks through February. Distillate, though, at the same time, we normally have draws at this point in time, and you can see we're starting from a lower point, and the rate of change will be a bit shallower than some of the other periods, but because of how low we're starting, it's still going to be in a bullish position. It's still going to be positive. So a positive for the refiners. So again, that's something that we're going to watch and talk more about in the next segment. Jet starting at the low end, we do see some of those builds coming over the next few weeks. And then when you look at the crude futures, you can see we're still in contango, but again, we just had a shift up, and we think at this point that we're going to stay between, again, as we said previously, we were a bit too low, so it makes sense to have this move up. but you can see that the whole curve has moved up, which is a positive when you're thinking about new production, new investment. And that's why we are more bullish the curve than we are the front month at this point in time. And then floating storage has increased. We're now above 2022 levels, which is why I think there's a lot of support for additional imports into Pad 3. Again, this is just in terms of where things are in that transition from offshore to onshore, which we should see additional flows. So that's what we have for you on the global side, and kind of the generality. In the next segment, we're going to get deeper into refined products, and really, are we going to see a meaningful increase in demand? And the short answer is no, but we want to go through the semantics and the data on why.